The stock market down over 700 points, the worst day of 2025 so far. So let's get into what exactly happened right now. We're going to go over to CNBC, and you can tell by the look on these guys' face. Looks like one of my thumbnails. Let's check this out. So Dow dropped 700 points in fact, I think it's 750 for worst day of 2025 so far on new fears about economic growth, catching the market off guard, but definitely not catching rebel capitalist viewers off guard. That is for sure, or anyone that's been paying attention to the yield curve. Okay, stocks sold off on Friday as new U.S. data sparked concern among investors over a slowing economy and sticky inflation. Okay, I don't know about sticky inflation, because if it was sticky inflation, then what would be happening to the 10-year Treasury yield? Up, and it was down. Moving on here. Losses, hold on here. Stocks sold off on Friday. Okay, got that. Among investors over concern among investors over slowing economy and sticky inflation, leading them in search for safer assets. Right, like treasuries, but again, we'll focus on that in a moment. Losses intensified into the close as traders feared staying long into the weekend. That's usually a bad sign. Let me put it to you that way. When you're on a Friday and stocks close on or near the lows, and just the last 10 minutes of the day, they just tank. In fact, let's see what they did. Let's see the price action, the daily chart. We'll look at the S&P, but we'll use the Dow as a proxy. So yeah, I mean, the major move came from noon to about 3 o'clock, where it just Wile E. Coyote here. And then you closed not at the absolute low, but darn near it. And like we were saying, that is a big red flag for sure. So getting back to the details, a volley of data raised new concerns about, are these new concerns? They're not new concerns for anyone that watches this channel, that's for sure, about the economy, and sent investors into bonds, which caused yields to tumble. Okay, well, then it's not really sticky inflation, is it? What? You're sitting there talking about how the economic data is getting worse, and that's what's driving people into bonds, but that would insinuate that growth and inflation expectations are declining, not necessarily sticky inflation, kind of the opposite of that. The University of Michigan Consumer Sentiment Index fell to 64.7. Okay, I'm going to save that because we're going to get into the exact survey. We're going to go to the website here in just a moment, but really kind of staggering numbers, especially when you compare them to expectations and where we were last month. A huge decline just since last month. So the 5-year inflation outlook, that skyrocketed. So it's like the consumer is worried about one thing, and the bond market, or the consumer is worried about two things, I think. Slowing economy, slowing job market. That's usually what this stems from when you look at the consumer or the average American. And then sticky inflation, where the bond market is more so looking at this and saying, okay, we're not really worried about the sticky inflation. We're worried about the economy slowing substantially. And that's why the long end of the curve down. Okay, getting back to this, Walmart shares fell 2.5%, marking a second day of declines. That's surprising. I thought people would buy the dip on the decline yesterday. Prominent investor Steve Cohen shared some negative comments on the market and economy from a conference in Miami. Looks like here's a quote from him. It's definitely a period where I think the best gains have been had. It wouldn't surprise me to see significant correction, citing proposed tariffs dragging on the economy, as well as some government cost-cutting efforts. Yeah, so longer term, that's good, right? But short term, it definitely decreases GDP. That GDP is just simply government spending plus, well, it's all spending, but let's just say it's government spending plus private sector spending. So when you reduce the government spending, well, of course, with that formula, you're going to get lower GDP. Now you say, George, that's a good thing. I completely agree over the long run, but in the short term, it does increase, let's say, the probabilities of a recession as defined by 2 consecutive quarters of negative real GDP. And probably a big spike in the unemployment rate. Because remember, one of the main reasons the unemployment rate is so low is because the government was hiring so many people in the latter part or throughout 2024. So if you eliminate, let's just say, half those jobs, that unemployment rate is definitely going to spike. And those people are going to need to find other things to do. And in the interim, they're not going to spend as much money. Aggregate demand goes down. And whether it's the 1970s or the 1980s or the 2000s, this usually, I'm talking about aggregate demand declining, results in a recession, and that usually results in disinflation. Even in the 1970s, the decade of stagflation, if you look at the recession of 74, 75, especially when the unemployment rate spiked, and the one going into the first part of the 1980s, you see disinflation. I think that's kind of what the bond market's sniffing out. Okay, now let's go over. So here, this is really interesting. Odds surge for 2 to 3 Fed cuts by December of 2025. It's amazing. We just go back and forth and back and forth. The market is just totally bipolar on what they predict for Fed rate cuts. You look back 6 months and it was, what was it, 6 or 7 rate cuts? And then you go back 3 or 4 months prior to that and it was no rate cuts. And then it goes to 6 to 7 and then no rate cuts. Now we're back to 2 to 3. And most likely in the next 2 or 3 months, we're going to be back to 6 to 7. But if you study history, you see that this is very common in these cycles. It's very similar to the way it played out in 2008. Not exactly, because this time, around this time, January, February, they were really, really cutting rates. So that would be different. But the point is, you have all this noise and the market just can't deciding what the hell is going to happen, and over here, and then you're way over here. And it's just nature of the beast. Trading in 30-day Fed funds futures contract Friday now suggests roughly 55% odds Federal Reserve will cut rates 2 to 3 times by the end of the year to a range of 3.5 to 3.75. Let's just say 3.5, where today it's 4.25. The odds on Thursday stood at about 44%. So big jump there for sure.
Hey guys, I'd like to personally invite each and every one of you to attend this year's Rebel Capitalist Live. This is the incredible conference I put on annually that helps you build a bulletproof portfolio. It helps you increase your personal freedom and liberty, and also it helps you increase the size of your network. In other words, you get to meet a lot of like-minded individuals, fellow Rebel Capitalists. It's in Orlando, May 23rd through the 25th. Past speakers have included people like Robert Kiyosaki, Ron Paul, Peter Schiff, Mike Maloney, Lynn Alden, just to name a few. So to get your tickets ASAP and to find out who is speaking at this year's Rebel Capitalist Live, you can check it out at rebelcapitalistlive.com. And just a little quick insider information, if you get your tickets sooner than later, you can get a discount, because as we get closer and closer to the event, the tickets go up in price. So don't wait. Go to rebelcapitalistlive.com right now and get your tickets, and I will see you in Orlando, May 23rd through the 25th.